Okay, so basically when we do financial statement audit, okay, the scope of the audit is actually financial statement. Okay, that means our scope, this is very important because when we do our any engagement with a particular client, when you are being appointed, it's very important for us to define what is actually our scope of work. Okay, because that would actually define what are accessible by the auditor at the client's place. All right, and then of course also what's this? I mean the tasks that you will do, okay, the things that you should, procedures that you should do, and so on. Okay, so basically the scope is financial statement. Okay, financial statement for the year ended so and so. So we have to define for which particular year ended, hence you would actually cover for that one accounting period basically. Okay, because in the financial statement you have profit and loss account, okay, which is transactions for a particular financial year, most normally year, right, unless they change the accounting date. Hence it could be less than 12 months or it could be more than 12 months. Okay, so you would actually basically auditing the financial transactions for one particular year, okay, because when we're talking about P&L, it's actually reflect the transactions, okay, for that particular financial year. Okay, and then when we're talking about statement of financial position, okay, statement of financial position, the title itself tell you that financial position as at, okay, as at 31st December 2020. Hence, you are actually validating or verifying the balances. Okay, so you have to really understand when I mention transactions, when I mention balances, right? Because when we audit, we actually audit what? Okay, right? So if it is P&L item, we are talking about transactions. Okay, but if we are talking about financial position of balance sheet item, hence we are actually talking about balances as at particular date. Okay, so basically we are talking about assets and liability and also equities as at 31st December 2020. Okay, all right, so that is basically our scope of audit. Okay, and then in addition to that, we also I also already explained, okay, the objective of the financial statement audit. Okay, the objective of the financial statement audit. So basically, okay, the objective of the financial statement audit, basically most of the time you are actually trying to give true and fair view of the financial statement. Okay, true and fair view. True means whatever figures inside the financial statement is actually accurate, okay, exist, complete, and so on. And fair means is actually reflect the fair presentation. Okay, it's talking about the fair value, it's talking about the fair presentation and also disclosure that the client must actually follow with. Okay, so that's the first one. All right, the second one is actually we want to ensure that it is actually free of material misstatement. Free of material misstatement, we are trying to look at misstatement that have a material impact. Okay, because when we do our work, okay, when we do our work, we might come across any misstatements or errors that actually been done by the clients. Okay, so whatever misstatements which is significant amount, hence we have actually taken care all those things. All right, so we have actually by right should have done all the necessary adjustment and so on. Okay, so that's why in this context we are applying materiality concept. Okay, materiality concept, meaning as an auditor, remember just now I'm talking about transactions for the whole year and balances as at a particular date. Okay, so when talking about transactions for the whole year, it's not all transactions would have significant impact to the overall financial statement of the company. Okay, so perhaps one particular transaction only carry a value of 500 or perhaps 1,000. So for that particular company, that amount is insignificant. Hence, if there are any misstatement whatsoever, All right, so it's okay if auditor did not adjust, or maybe they advise the client, but if the client don't want to adjust, it's fine, because the impact, okay, of that particular transactions or balances is immaterial to the overall financial statement. Okay, the same thing with the balances. All right, for instance, inside your accounts receivable aging. Okay, inside your account receivable aging. Okay, what is account receivable aging? All right, so if you actually, I'm sure you have learned about account receivable. Okay, so about account receivable, what happened is that you have a balances of all the customers as at year end. Okay, and some of the customers owe you a lot of money. Some of the customer only owe you certain amount of money. Hence, the amount might not be significant. Okay, then also the same concept of materiality applied. Okay, so basically when we do our work as an auditor, all right, we already set our benchmark. Okay, we already set our benchmark. Materiality is actually a benchmark that we set in the beginning of the audit during the planning. Okay, so during the planning, we set the benchmark level. Hence, we know whichever that below maturity level, for us as an auditor, it is acceptable. Okay, that means there is no significant impact to the overall financial statement. Okay, and then whatever above the maturity level, definitely that is what drives the attention of the auditors. Okay, that will bring to the management respective those charged with the governance and so on. Okay, all right, so that is talking about any material misstatement. Okay, later I will re-emphasize about ISA 240 with regard to the responsibilities of the auditors in regards to fraud. Okay, because there always exists the expectation gap between the user and also the auditor. Okay, and then the third objective is, just now I'm talking about the scope is financial statement. Okay, the scope of our audit is financial statement. Hence, we are actually checking, all right, we are actually checking the financial statement is actually prepared in accordance to the financial reporting standards. Okay, applicable and approved financial reporting standards. So we have to know. All right, of course, if we are auditing the companies in Malaysia, hence we are following MFRS. However, there are sometimes subsidiaries of a foreign company. Okay, so perhaps their HQ is actually US. Then perhaps they have to follow GAAP. Okay, because US is actually using generous accounting accepted principles. Okay, GAAP different from. That means they did not follow IFRS. Okay, so we have to know. Okay, we have to know, because whenever we do the debit credit, whenever we do the measurement, the valuation, okay, how they recognize the item, okay, classification, okay, presentation and disclosure, everything would actually goes back to financial reporting standards. So we have to know by heart, okay, what are the element or contents inside the MFRS. Okay, so hence when we go and check the client, and we can actually ensure we know that this particular client is actually prepare their financial statement in accordance to the Malaysian financial reporting system. Okay, MFRS. All right, so that is our benchmark. Okay, all right, don't confuse with auditing standards. Okay, accounting standard we use as a benchmark to check our client's financial statement. Auditing standard is actually for auditor to refer to in order to conduct audit procedures. So it's two different standards. Okay, all right, and then the fourth one objective is actually independent opinion, meaning that when we provide our opinion, okay, we are independent because we are external auditor. All right, basically when we accept the client, we are actually have no interest. Okay, that means there is an absence of conflict of interest between the audit firm and the client, because by right, if you have conflict of interest, then by right, you should not actually accept the engagement. Okay, so Being independent also, giving out independent opinion also important, okay, because our audit opinion is actually being used by the many users. Of course, ultimate user is the shareholders. Okay, we report to the members, to the shareholders, to the management. Okay, but ultimately, the audited financial statement is normally available to the public. Okay, it is a public information. Hence, a lots of people, okay, financial analysts, bankers, okay, government authorities, in fact, investors, okay, so a lot of stakeholders are actually using our financial statement. Okay, so when we give independent opinion due to our competence, in a way we actually enhance, okay, we are actually enhance, okay, the integrity of the financial information inside the financial statement. At the same time, we also boost up the trust and confidence of the public towards the value, okay, the value of the information that we have actually audited or we have actually checked. Okay, so these are basically the main four objective of why the external auditor is actually preparing or doing the financial statement audit. Okay. All right. Of course, when we go to client, all right, we already explained to the client, these are the management responsibility. Okay. So when everyone knows that what are their responsibility respectively, hence there shouldn't be any disputes. Okay, there shouldn't be any dispute in the sense that I know what is my job scope and I know what is your job scope. Okay, so hence we know what we should do. Okay, as an auditor, we know what we should do. As a management, you also know what you should do. Okay, in order to complete the overall financial statement audit. Okay, so to ensure that financial statement is prepared in accordance to the financial reporting standards, okay, meaning that it is the responsibility of the preparer, which is the accountant, okay, and also to ensure that internal control within the financial reporting process are implemented properly, okay, because sometimes when we go to the client, we do have check, okay, their internal control, so on and so. Okay, we do found that they do have SOP, but when it comes to the implementation, it still go back to the client, okay, to the management, all right. It is their responsibility to ensure that internal control are actually being implemented properly. Okay, in terms of corroborative statement, what is corroborative statement? Okay, when we do audit, okay, sometimes we get explanation from the client. Okay, we get explanations from the client or clarification from the clients. Hence, that statement is actually being documented in our working paper. Okay, so clients must aware that whatever their statement is actually will be used as an evidence, okay, in the course of the audit. Okay, so they have to know that, all right. So meaning that they must know whenever they give clarification or information, it must be a very accurate one, relevant. Okay, all right. So very important is the accurate one, okay, and reliable. And then management also must be aware that should be allowed to access everything. Okay, there shouldn't be any restriction with regard to any information that would have relation to the financial statement. Okay, they cannot say that, oh, this one is private and confidential, auditor cannot check. Okay, all right, for instance, like payroll of the directors. Okay, payroll of the directors, they say that it's a very, very private and confidential information. Okay, all right, and in fact, whenever the calculation is being done, it's only be done by the manager of human resource. Okay, because they don't want to share that information, confidential information, to everyone. Okay, so in fact, when auditors want to come and verify, they say cannot. Okay, so what happened if that situation occurred? Okay, so for auditors, we have to know, okay, when in the course of the audit, there shouldn't be any restriction, okay, because if there is a restriction to access, okay, any information or records, hence it might change your audit opinion, even though everything the rest is all okay, true and fair. okay, but because they limit you from not assessing directors' payroll, okay, or benefits, hence you cannot conclude whether the amount is actually accurate, okay, fairly presented, and so on. So you might want to change your audit opinion from the normal unqualified to a different type of audit report. So we will actually see later on in the auditor's report. Okay, so here what we must know is that management must allow us to access any information that relevant for financial statement. Okay, audit clients also is the one that responsible to ensure that every operations of the company is actually in compliance to the law and regulations. So they have to know. For instance, MCCG, then if they need to comply with, if they are listed company, they need to comply with, right? So they are the one that must know, okay, what are the things that they might comply with, okay, and have they actually comply with, and so on. Okay, the same thing with the tax regulation, environmental regulation, okay, or any kind of laws that we enforce on a company. Okay, so they must actually comply with that. Okay, so finally, all this management responsibility is actually being mentioned in the letter of representation. Okay, so normally we will get lah. All right, this is an extract. Okay, so that's why management must know what are their responsibility, because all this actually will be reflected in the the audited financial statement. Okay, the director's statement. Okay, the auditor's opinion, and so on. All right, so you can see here is clearly mentioned. Okay, who is actually responsible? Okay, for the preparation of the financial statement. In accordance to what, okay, and which particular regulations that relevant, all right, and then also with regard to the internal control, who is actually responsible, okay, and then what are the assurance that actually being provided to the management, okay, and then the going concern also is actually responsibility of the management that they must assess, okay, then of course auditors come and check and verify, okay, whatever their assessment and auditors assessment is actually tally, okay, or jive together. Okay, what about auditors' responsibility? These are the auditors' responsibility. First, to give reasonable assurance. Okay, reasonable assurance means that of course, when we do work, our work is we are doing on sampling basis. Okay, so of course, there are also certain items that we do on population basis. Okay, but overall, we might not know everything about the company, even though if we check the whole population, for instance, okay, because there might be some information that did not come to our attention as an auditor. So that's why we can actually just provide reasonable assurance instead of absolute assurance. Absolute assurance means 100%. Okay. So until now, okay, even though during with the data driven audit approach, okay, we are still actually goes on the basis of reasonable assurance. Okay. And then auditor's responsibility is to perform audit procedures. Okay. What audit procedures to do? It is actually driven by the audit objective. What kind of audit evidence that we need to cite? Also driven by audit objective. So later we will actually look at audit objective. Okay, and I really want to emphasize on the importance of audit objective in your audit fundamental. It is applicable for all cycle, okay, that you will learn later on. Okay, it is applicable for all cycle, business cycle that you would actually learn throughout the semester. Okay, because you are testing, right, just now, verifying and so on. So it is actually based on audit objective. So you have to know. Basically memorize lah, okay, audit objective, audit procedure, and audit evidence, because question would actually say, for instance, okay, given to this audit objective, what will be the relevant audit procedure and what will be the relevant audit evidence, okay, in order to ensure that we achieve our audit objective. Okay, so that's why audit objective is actually crucial. Okay, and then in terms of errors and fraud, of course, we are not supposed to detect fraud. Okay, but if we get some clue, okay, we get some found some irregularities, okay, or indicators, okay, and then we have to highlight the red flags to the management. Okay, most important, we reflect to the management. If no response, then we reflect to the audit committee. If no response, then only we reflect to the or report to the authority. Okay, so that's in terms of errors and fraud. Okay, about the going concern, okay, about the going concern and audit opinion. Just now, client assess their status of going concern. As an auditor, we also assess, okay, because it is one of the mandatory requirement under ISA 700, because you have to assess. If you believe that it is okay, then no particular disclosure required. But if you think it is not okay, hence you have to put in the notes to the accounts, okay, or perhaps in the disclosure, all right, or perhaps in the audit opinion. So going concern is actually very crucial, especially now during the pandemic time. Okay, you have to state what is the status of the business continuity. Okay, and then as an auditor's responsibility, okay, of course, whatever that we do is as prescribed by the law and regulation. Okay, so we also make sure that whatever that the client need to comply with are actually being complied with. So on top of the FRS, auditor also need to know several other regulatory frameworks. Okay, it depends on the industry that you are in. If you are in the financial industry, hence you have to know more. Okay, you have to know all the guidelines, okay, the policy document that actually being issued by the Bank Negara as a source of reference for the bank operation. Okay, because we have to know, right? Then only we know whatever operations that being implemented by the client is actually in accordance to the relevant regulations and law. Okay. So last but not least, of course, reporting, okay, ultimately reporting to the members, okay, then reporting to the management, of course, together with the board of directors, okay, the committees and so on, all right. And finally, the audited one will be submitted to companies commission, okay. If you do the statutory audit, you will come across this one particular form 49, okay, whereby when they want to do the submission, okay, to the company's commission, right, then basically they have to follow a certain standards. Okay, so these are in terms of auditor's responsibility. Okay, any questions so far? Okay, so these are the responsibility. Also, again, being stipulated inside the auditor's opinion. Okay, you can go to any audit opinion. Okay, all audit opinion in the contents of Malaysia are actually following this more or less similar format. Okay, this is all. So you see, all right, what the auditors need to exercise professional judgment, skepticism. Okay, they also have to ensure that the evidence is sufficient and appropriate, which is the criteria of the the criteria of the evidence. Okay, and then internal control also we assess, right? Accounting policies also we assess. So as an auditor, there are actually lots of things that we must be familiar with, okay, in order to do the audit work. Okay, see the one that I underlined, going concern basis also, all right, also important. Overall presentation, it is actually referred to the presentation of the and also disclosure of the financial statement. Okay, is it tally to the required presentation and disclosure as stipulated in the MFRS? Okay, so last but not least, all right, reporting, right? So communicate. Okay, we have to communicate to the directors. Okay, communicate to the directors and also management, and also we call it those charged with governance. Okay, so auditor's mindset, right? So you must be able to differentiate, what is professional skepticism and then what is professional judgment. Okay, skepticism carry two criteria. You always have question in mind. You always ask why to your client. Okay, why is that so? Why is that? Why is it like this? Okay, and so on. So the why question, all right, you want them to answer your why question. And once they give you your answer, you have to critically assess. Okay, so critical assessment is actually crucial. Okay, you question, all right, you always question whenever you are being given the integrity, is it the right integrity? Okay, so basically as an auditor, we have to know what it would be the right information, okay, for that particular item, for instance. Okay, all right. So that's why understanding of the business is actually very crucial. So those are professional skepticism. It's not that we are not exercising husnuzon, okay, but we do have our husnuzon, but sometimes this kind of people are very cheeky. So we have to know what are their tricks and so on. Okay, professional judgment is actually referred to judgment, decision. Okay, auditors make a lot of decision. All right, whenever you want to decide, okay, what types of audit procedure that you want to do, whenever you want to decide uh, your basis of your sampling, okay, whether you want to go to this particular criteria or you want to go for this particular criteria, you make judgment. And then whenever you want, you have already cited the evidence, then you want to conclude, is it everything is all fair? Okay, is it no issues with regard to the item or what? Okay, so you have to know, basically judgment is actually to ensure, okay, your mindset in preparing the decision, okay, in making decision is actually unbiased. Okay, so for you to be unbiased, you must be independent and competent. Okay, so that is with regard to judgment. So there are two different things, skepticisms and professional judgment. Okay, this is with regard to the fraud. This is very recurring issues, expectation gap between the auditors and the client or even to the public. Okay, so as an auditor, our responsibility is not to detect fraud, is not to detect any illegal acts. Okay, so in the first slide, I already highlighted what are the illegal acts that actually being committed by the client. Okay, that means manipulation in regards to the financial statement. Okay, therefore auditors have to be very smart. Okay, so you have to know as an auditor. In fact, one thing, sometimes client also might ask you, okay, I don't know how to prepare this table. Okay, then they will ask you, since they know auditors knows everything, right? So the client, can you please prepare me that table? Okay, so are you supposed to do that? Right? For instance, table of prepayment or perhaps table of higher purchase interest. You ask from your client did not give because they don't know how to do it. Okay, and you also tell them, okay, you do like this, and then they finally decide, since you know, why can't you do it for me? Okay, all right. So as an auditor, should you do that? Okay, so we have to know what is actually our do's and don'ts. So in that scenario just now, if the client asks you to prepare the table of hire purchase, should you do that? Okay, if you want to do it for your own working paper, yes, you may go ahead. But if you are preparing one and you pass to the client, it is actually not right. Okay, why? Number one, it is considered as an accounting job. You are coming to the client to do the audit, not to do the accounting work. Okay, it's a two different job scope. Okay, so that's why we are not allowed to help the client doing the accounting work. Okay, whatever the table, whatever the supporting appendix, whatever things. Okay, then if you want to do it for your own audit working paper, go ahead. But we should not give that to the client. Okay, because that is actually our workings. Okay, our workings, our work. All right. So auditors must really know what you can do, what you cannot do, especially when you are still new. Okay. First 6 months, you are still new. You just follow your senior. So you're not really sure. Okay. So that's why in audit world, all right, when you are still new, just join. Okay, you will not tell client you just joined. Though some expert can tell you actually new into the audit. Okay, but normally your senior will tell you not to tell you just joined yesterday. Okay, you shouldn't tell your client because sometimes client tend to bully you. All right, because they know that you don't know how to do the work. Okay, so they tend to bully you. Right, so that's why as an auditor we have to be very smart. We have to know what we need to do. Okay, so these are the ISA 240. Basically, it's talking about professional skepticism. If you want to have a look, you can just Google ISO 240. You get the standards, and you can actually quickly go through. Okay, what does it mean by professional skepticism? Okay, what does it mean by risk assessment procedures? Because this one you will do later on in the planning. All right, and how to identify risk, how to assess risk, okay, how to respond to the risk, okay, and then how you want to evaluate audit evidence, okay, and if let's say auditors cannot continue the engagement, what would be the auditor's responsibility and so on. All right, so here they actually mention about the responsibilities of the auditors, particularly in regards to the identification of the fraud. Okay, because it's always like public expect auditor is actually the one that should found all the errors. Okay, not errors only, all the errors they expected. Okay, they thought that auditors should have, when they do their work, they should have done all, check all everything. Okay, so those are some perceptions or misconceptions. Okay, that's why we have the, what we call it is expectation gap. Okay, auditors, we know as an auditors, this is what we are supposed to do in accordance to the auditing standard. But public or users of the financial statement expect auditors to do this, and this, which is not specifically mentioned or required by the act, by the standards. So there is a gap, okay, between. That is what we call expectation gap. Okay, so that is also one of the ongoing issues actually being discussed with regard to expectation gap. Okay, all right. So, okay, these are the okay, management accessions. Audit objective is the one that I really want to emphasize. Okay, emphasis to you that you have to know and do not confuse yourself. Okay. First, management accessions. What are management accessions? Management accessions is actually what are being claimed by management on items that been presented in the financial statement. Okay, what the management claim, okay, about item presented in the financial statement. So it will cover transactions, which is your P&L item, and it will also cover balances, which is your financial position item. Okay, everyone can follow? Okay, this part, if you are not clear, please do ask me, okay, on the spot. Okay, so when we say that, okay, so there are few accessions, right? Number one is existence, completeness, valuation, accuracy, rights and obligations, presentation and disclosure. Okay, what does it mean each and one? Okay, existence. Okay, so if inside the financial statement, okay, for instance, in the revenue, in the revenue for that particular financial year, and they have a revenue of 1 million. What does it mean? It means that management claim all the revenue of that 1 million revenue is actually exists. Okay, what does it mean by exist? That means the transaction occurred. Okay, there is a order take place. Okay, and then there are delivery is actually being made to the respective customer. Okay, so it is exists. Okay, it's not a bogus revenue transaction. Okay, which is not in existence. Okay, so exist means actual. all right, the transaction is actually actual occurred. Okay, all right. Complete means this is talking about the period. For instance, transaction, apa ni? PNL is covered for 1 year. That means you cover from 1st January up until 31st December. So meaning that you are actually capturing, okay, revenue of that 1 million is actually to reflect the revenue that occurred from 1st January up until 31st December. Okay, that means revenue is actually occurred from 1st January up until 31st December. How do you know that? Okay, you have to go back to the policy of recognition. How the company recognize the revenue. Okay, how the company recognize the revenue. Anyone can tell me how the revenue is being recognized? How is revenue being recognized? Anyone? Any volunteer? Esni? Esni, any idea how the revenue is being recognized? Macam mana nak capture revenue dalam account?
Do you mean like credit?
How you do the record?
Do you mean by credit revenue?
Macam mana? Credit revenue. Okay. When you want to credit revenue, you based on what document? Yang lain get ready Boleh Esni?
Not sure, madam.
Tak boleh? Not sure. Okay. Next. Ashbil. How do we recognize our revenue? Ini yang bila pergi audit nanti kena tembak sebab it's actually very basic, but because the practicality is actually not happening in your study, okay, so sometimes it's actually being looked over, okay. How we recognize our revenue? Ashbil, Kamal? Shafiq, yes.
Is it when the service are rendered or?
Yes, service are rendered, yes, we recognize. But how do we want to know? That revenue should be recognized at what point of time?
At the time when the good is delivered.
Okay, apa dokumen yang diguna?
Invoice, madam?
Invoice. Okay. You all selalu shopping kan? Okay, you all sekarang ni shopping online lah, shopping COD lah, whatever kan. In fact, you even go to the physical brick and mortar shop. Okay, alright. So all being exposed to you. It's just that you all have to alert. Okay. So, for instance lah, you buy from Shopee. What actually first thing that you do? You raise an order. Betul tak? Okay,
Yes,
you browse the apa ni the site. Okay, you pick the item and then you click, go into your cart. Okay, and then after that you already confirm, you place your order. Kan, biasa buat kan? Okay, so you place your order. So once you place your order, you make your payment. So what happened at the back end of the system? Okay, what happened at the back end of the system? Meaning that now when you place your order, the order is actually being received by the supplier. Okay, so you are so-called their client, isn't it? Their customer. Okay, so the customer, you has actually placed the order. Okay, so of course there is an order slip or order booking slip. Okay, if maybe some of you also might have been doing some selling on Shopee, because now you can do that also, right? Okay, so you will receive the order notification. So that is actually considered as an order document, okay, to prove that the order has been received. So once you receive the order, what actually happened is that You want to fulfill the order. Okay, so you take note, okay, today I received this order. So you go and get your stocks, pack, and then you send it to the Pos Laju ke, JNT ke, whatever. Okay, so you send it to, because you want to send it to your customer. Okay, of course, if you are seller at the Shopee, you don't actually prepare a proper invoice or proper delivery note. Okay, but in the normal business, let's say when you go and buy a computer, all right, at the shop in the mall, okay, they would actually give you an invoice, okay, and then if sometimes they also deliver to your house, they will actually give you another copy of delivery note or delivery what do we call it, delivery order, okay, together with the sales invoice, where sometimes they ask you to acknowledge. Okay, perasan tak kadang-kadang bila post laju pun send to your house, they will actually verify. Okay, who receive it? They want your IC. Dulu-dulu ada kan? Okay, they want your name, they want your IC. Okay, so that is actually verification that the goods has been delivered and received by the customer. Okay, so basically there is a whole process that happened, okay, when we're talking about the revenue. So at what point, okay, now go back to my question, at what point we want to capture our sales? Okay, at what point we want to capture our sales? Is it at the point of when we deliver the goods, if it is a goods? Okay, because later you have services, right? Okay, so is it at the point of when we deliver the goods, or is it at the point of when we bill them out? Bill them out means we issue invoice, because sometimes deliver dulu. Okay, bila dah deliver, then later baru you issue invoice. Okay, and then another step will be payment. Okay, alright. So at what point of time that you want to capture your revenue? Okay, so when we're talking about revenue recognition policy, you can actually go and open up any annual report and check revenue recognition policy note number 2 inside the notes to the accounts. Okay, they would actually explain how the revenue is actually being recognized. Okay, so most of the time they would actually say that the revenue is being recognized based on the amount of the stated in the invoice. Okay, all right. So in other words, the company is actually taking the point of issuance of the invoice, then only revenue is actually being recognized. Okay, so it is actually decision of the management. At what point they want to capture their revenue. Okay, they can decide at the point of delivery, at the point of invoice, or at the point of payment. Okay, because sometimes you have doing cash sales, right? Okay, like jual goreng pisang ke, nasi lemak ke, as well at the time of payment. Right? So it depends on the company policy, but that policy cannot be changed. It has to be consistent throughout your financial year. Okay, all right. So coming back here, completeness. Okay, because I want to explain about completeness. So we have to know, okay, which point that you want to recognize your revenue and what are the basis of the document that you are actually using. So two things, what particular point of time, what particular document. Okay, then we know, all right? Because whatever document, so your year end is 31st December, right? Meaning, if you are based on the invoice, so the last invoice issued on that date, that is the stop point for revenue to be recognized in that financial year. Okay, so if the running number 123 is the last invoice issued today, so meaning invoice number 124 will be issued tomorrow. So that will be next year. That's what it means by revenue recognition policy. It means complete. All right. So you have to ensure that when you go to the client, you would actually ask them, okay, so what is the last invoice issued for the year? And then you go and check the sequence number, the running number of the invoices issued from the general ledger. All right. And then you see, you can actually see, so whatever invoice before that number, all should be captured in during that particular year. Whatever invoice after that 1, 2, 3 number will be captured in the following year. Okay, so that's what it means by complete. Okay, all right. Can you all follow? Is it understand? Can you all understand that? The process?
Yes.
Okay, so that is actually completeness. Okay, the next thing is actually valuation. Okay, what is valuation? Valuations means, okay, valuation and accuracy normally go in tandem, all right, because it's talking about the amount, all right, the amount of the transactions or balances. Okay, so in the case of just now, the invoice, right? Okay, the invoice. So what do we have on the invoice? How do we know how much is the amount? Basically, we need to know the quantity, right? Okay, how many quantity we order, and then what is the price? Okay, what is the selling price of that item? Okay, so here in business, all right, if you buy during the sales 11/11, then normally you have discounted price. If you buy during the normal time, then there is a normal price. So it's the price is two different price. Okay, one is the normal price, one is the discounted price. Okay, so in talking about valuation and accuracy, that means we must make sure that, okay, this invoice is actually for the sales, normal sales. Hence, the selling price should be using the normal selling price. But if we know that that sales is actually for discounted sales, okay, during the sales time and so on, promotion, so the price is actually discounted price. Hence, the price on the invoice should be discounted price. Okay, so the accuracy of the price is at valuation, and also accuracy talking about the calculation. So the amount of the invoice is actually based on what? The price multiplied by the quantity. Okay, price multiplied by the quantity. So if let's say one item is 10 ringgit and you buy 4 items, so total is 40 ringgit. So you do check the mathematical accuracy. Okay, so 10 times 4 is actually 40, and the amount at the bottom is actually 40. We call it, we recalculate, okay, the amount of the invoice. All right, even though sometimes you can see that on the invoice is computer generated. Okay, it's computer generated, but sometimes there are some errors inside the system. So maybe the price is, they take a wrong price. Okay, hence the overall amount is actually inaccurate. Okay, so that's why as an auditor, we have to know when they're talking about the sales price, which price list that they are referring to. Is it a normal price list or is it the discounted price list? Okay, that is an example of valuation and accuracy. Okay, another example that I can give also is with regard to the account receivable. Okay, because just now is transactions, right? Now I'm talking about balances. Okay, in terms of the balances, let's say for instance, account receivable, okay, as at particular year end, okay, we know that that particular customer owe the company 100,000. Okay, 100,000. However, we know that that 100,000 come from many transactions. Okay, many sales lah that purchased by that actually you have a sales transaction with that particular client. And when we go through the aging, we notice that, okay, one invoice has been like aged about perhaps 6 months. Okay, the 10,000 is aged about 6 months, and the amount is in dispute. Okay, so the client refused to pay. Okay, refused to pay. Hence, it is a question about the collectibility of the amount of 10,000 just now. All right. So now, when you want to reflect the fair value of the balances as at year end, should you actually put 100,000 or you should just put 90,000? Okay, because we want to ensure that the proper value, fair value, because when we're talking about receivable, these are the amount that can be collectible. Okay, so if we know for certain that this particular amount is uncollectible, hence you want to do some impairment, meaning the fair value of the receivable would only be 90,000 instead of 100,000 just now. Okay, so that is another example how the valuation is actually being made, okay, based on our assessment with regard to the requirement of the financial reporting standards. Okay, because all this impairment all be mentioned in the financial instrument FRS, okay, about the assets, particular cash, all those things. Okay, so there are certain treatment that we need to go as the valuation. So client is actually claim that, okay, these are the valuation of their revenue and also valuation of their receivables and so on. Okay. Any questions so far? So existence, completeness, valuation, and accuracy. Is it clear? Okay. Okay, if no question, I proceed to the next one. The rights and obligations. Okay, the rights and obligation is actually reflect ownership. Okay, reflect ownership. Okay, what does it mean? It's the rights, the assets, whatever assets on the financial position is the rights. Okay, it's actually owned by the management, by the company. Obligations is actually refer to liabilities. Okay, you are obliged, okay, to fulfill the payment of the liabilities. So in other words, it's actually reflect the ownership, meaning whatever assets on the financial position, whatever liabilities on the financial position is actually owned by the company. You are actually capturing the assets that belong to you and also liability that belong to you. Okay, you not overstate, you are not understate. Okay, all right, that is rights and obligation. And last but not least is the presentation and disclosure. So presentation and disclosure is actually the presentation lah. Okay, presentation of the financial position and also SOCI, definitely in accordance to the whatever the current practice in the MFRS. Okay, and also to the notes to the accounts. All right, because let's say for the PPE, okay, property, plants and equipment, how you want to disclose. Okay, you have to disclose the cost value, the accumulated depreciation, the asset net book value, etc., etc. So there are certain format that the company have to follow, okay, whenever they do the disclosure, okay, and also presentation of their financial statement. Okay, so it must be in accordance to the respective financial reporting standards. Okay. All right. So this is management assertions, meaning that management claim whatever on the financial position, financial statement is actually exists. Okay, it is actually complete, reflect to the proper accounting period, properly valued and accurate, and it is all owned by company. Okay, and presentation and disclosure are in accordance to the required regulation of frameworks. Okay, what about the audit objective? Okay, if you see the audit objective is actually more or less reflect the same thing. Okay, reflect the same concept. Okay, all right. So audit objective cover transactions, which is a P&L item. Okay, balances, which is financial position items. Okay, so it's the same thing. The first item we are actually testing. So when we do our testing, what do we want to test? Client said revenue exists. So what is our first objective? We want to ensure is it all exists or not. Okay, transaction that claimed by the management is actually all in existence. The balances that they have in their account receivable is all exists. It's not a bogus receivable, for instance. Okay, so we are actually testing. Okay, we want to test, right, whether whatever transactions that they have in the P&L is actually exist. The balances that they have in the financial positions are actually in existence. How do we test that, that would actually go to your audit procedure. What do we want to do in order to ensure that the transaction is actually in existence? Okay, all right. So later when you do audit procedure, you have to know what audit evidence that you need to do the citing. Okay, I give you an example. Just now I'm talking about revenue recognition policy. Okay, revenue recognition policy. So in the revenue recognition policy, what happened is that we capture our revenue based on invoice just now. Okay, so whenever they issue the invoice, so based on the invoice, you debit your account receivable or cash and then credit your sales. Okay, all right. So how do we know the transactions exist? Of course, we ask the client, I want to see your invoice. You go and perform the citing of the documents to prove that the transactions are actually occurred. How do we know it is occurred? That means there is a invoice being issued. But invoice being issued for what? For delivery that has been made. Why you make delivery? Because someone ordered. Okay, so you see how you go backtrack. Okay, so from the invoice, you want to see the delivery order. From the delivery order, you want to see the sales order just now. Okay, then from there, from all the documents that you have, you match. Then you check, is it accurate or not? Is it properly valued or not? Okay, all right, and then the date, is it being captured inside the system or not? Okay, inside the ledger at the proper period or not? Okay, so actually by performing citing of the sales invoice, that is actually being supported with the delivery notes with the sales order, you actually verified the sales are exist, okay, the sales are accurate, okay, and it is all complete because you already traced to the GL, it has been captured inside the GL, proper accounting period. So you see, from one audit procedure, citing of the documents, okay, you actually verified several audit objectives. Okay, so what document? So when we ask what is the audit evidence that you cite, the three documents just now. Okay, sales invoice, delivery notes, and sales order. Right, so you see how audit objective, audit procedure, and also audit evidence are actually interrelated. Okay, all right. So this is what you will learn throughout the whole business cycle later on. But of course, it will refer to specific transactions in regard to respective cycle. Okay, because like revenue cycle, okay, we are talking about how to audit sales and also how to audit account receivable. Why these two? Because when you have sales, you debit your account receivable, you credit your sales. Okay, because it works together. Okay, in the debit credit system, it works together. So you are in the same cycle. All right, and then if you go to purchase cycle, you are talking about purchasing, right? So purchasing means you are purchasing from supplier. So you will audit your purchases account at the same time you will check your accounts payable. Okay, because when you purchase, you debit purchase, credit your accounts payable. Okay, so that's why understanding of your accounting transaction is actually very, very important. And I will ask you a lot with regard to that. Because in order to audit, first, we have to know how the transaction is actually being recorded. Okay, alright. So kalau those who have clicked deleted button, for that all that you have learned in your file, please go and reload back, okay, all your memories with regard to the accounting transactions, okay, and try to recall back what are the relevant documents that you need to do the citing and so on. Okay, so perhaps this semester, okay, we could actually look at some of the documents, okay, because department has just purchased some a simulation package, okay, so that's we hope you can actually do some citing, okay, to some documents so that you are familiar with what document to do the citing, why this document, okay, why that document, and what to look for on the document and so on, okay, because very common students are blank when they go to the practical. They don't know what document to cite for this and so on. Okay, very like just now I'm asking about invoicing. Okay, how to capture your revenue. Okay, so that is actually very basic knowledge that as an accounting student you must know when you go for practical training. Okay, all right, so that what I will actually teach you throughout. Okay, especially when we come to the respective business cycle. So like coming back to this one, okay, so classification is what? Classification is actually this one, we want to ensure that when they capture that particular transaction, is that particular transaction should be an expense or should be an asset. For instance, they buy a computer, okay, they buy a computer, all right, and then of course, according to the company policy, computer, they want to capitalize. So hence it should go into debit to your property, plant and equipment instead of debit to your expenses. Okay, or perhaps when you buy table, because the value of the table is only 200, policy says that, management policy says that, oh, since the amount is too small, then we just expense off. Okay, therefore, we just capture as our expenses. That means we are not capitalizing it. So that is classification. Okay, all right. Timing is refer to the completeness as well. Okay, at what time you want to capture. Okay, timing differences. Okay, and of course, presentation is the format lah, how to present and disclose and so on. Okay, in terms of the balances, okay, cutoff is also referred to the completeness. Okay, that means the proper cutoff date, especially year end, all right, especially year end is we will check the cutoff. Okay, net realizable value is actually referred to valuation. Okay, valuation, all right. Valuations means that, for instance, you have your stocks. Okay, you have your inventories. Okay, you audit Giant supermarket. Okay, you have inside that inventory milk. Okay, cartons of milks. Okay, all right. So how much will be the value of the milks that being captured in your inventory? Should it be at the cost when you purchase the milk, or should it be lesser, or should it be higher? Okay, so what do? You check the age of the inventory. Let's say it's too long, okay, to the overdue date, then perhaps you can capture at the cost. Okay, but if let's say it's almost expired, can we capture at the original cost? We can't, right? Because we have to clear it very fast, and in fact, sometimes we cannot sell it at our actual cost, okay, actual price. So we have to discount it. Hence, the value of your inventory, the cartons of milk just now, have to be restated. That's what it means by net realizable value. So later when we go to audit, we actually will see lah, item by item. Okay, how to determine the valuation for the balances. Because there's a lot of concept of impairment. Classification also the same thing. All right. For instance, should you recognize your receivable as your trade receivable or the non-trade receivable? Okay, because trade means purely that refer to your core business activity. Non-trade is other than your core business activity. So again, this is also another classification that you should have segregated. Okay. And then rights and obligation is actually reflect ownership. Okay, as I mentioned just now, rights is you have the rights on your assets. You are obliged to settle your liabilities. Okay, so that's reflect ownership. And of course, last is presentation. That means the format of presentation and disclosure in accordance to the financial reporting standard. Okay, so you have to memorize audit objective. Okay, you have to understand each item, what does it mean? Okay, each item, what does it mean? Hence, later on, when we go for audit of financial statement item, you know what audit procedures would be relevant, and you would actually know which audit, which document will be used as an audit evidence. Okay, so if you remember your audit objective for the transactions and balances, you understand the concept. then you will be okay in your auditing fundamental, because the other half actually when it comes to the final exam is all about practical application of how to do the audit. Okay, so the first part of the semester is just to introduce you the concept, but later on will be application. Okay, so that's why in the next topic, we would actually cover the audit process. What actually happened in the planning, in the field work, and finally in the auditor's report. So you would actually cover all these three phases. Okay, you would actually cover all these three. Okay, so I will guide you how to do the planning later on. Perhaps we do some activities, okay, for you to get some feel, okay, how to do the risk assessment, particularly field work, of course. Okay, you will do a lots of vouching later on. All right, and finally audit report. Okay, so basically this is the things that you need to basically take note with regard to this topic, okay, that you should be so my emphasis for today's topic is your audit objective. You must really know it. Okay, you must remember the each item. Okay, what does it mean for each concept? Okay, and then how later on it will be relate to your audit procedures and audit evidence. Okay, all right. Any questions so far?